If you want rents to go down or to stay flat in a market, you're going to take a risk and buy a property with a low cap. Now, for those of you that don't know what positive leverage is, and this is something that I've been hearing over the last couple of years. Hello and welcome. My name is Gino Barbaro from Jake and Gino. And in this how-to video today, we're going to be discussing something that's been a big pain point for most of us in commercial real estate. How are you buying assets today with such high interest rates? It's been such a problem over the last 12 to 18 months. Things have been feeling as if it's just been stagflating. There hasn't been a lot of activity. There hasn't been a lot of action. We were so used to that drug of 2 and 3% interest rates. Even if you were buying a 4 cap, you still had what we call positive leverage. Now, for those of you that don't know what positive leverage is, and this is something that I've been hearing over the last couple of years, we did a recording on the Jake and Gino podcast probably a couple of months ago now. We had a gentleman who swore by he was buying shopping centers and strip malls and retail. I'm like, really, bro? How are you making that happen? He goes, it's very simple, Gino. I'm using, rates at 6, 7%, and I'm buying these shopping centers at 12, 13 caps. So he has positive leverage. He's buying a deal at a cap rate that is lower, he's buying a deal with a cap rate that is higher than what the cost of capital is. So you have a 5% or 6% interest rate, your cap rates are 9, your positive leverage. Now what's going on right now is people are buying deals, right, at 6, 7%, and they're trying to buy them at 3 and 4 caps. Now that works great when the market's doing really well, fantastic, and you're able to flip out. Things are going great. But as they say, the buck stops here. Well, the buck stopped in late 2022, 2023. That didn't work anymore. What Jake and I have done a lot in our careers, I didn't even know this is what it was called. We're buying deals based on yield of cost. So what that means is when you're buying a deal with a value add component to it, cap rates really don't mean anything, to be honest, because you're buying a deal that has very little, NOI. The NOI when you're finished with the property better be a lot higher than when you're buying it. So you're not buying it at its true worth. You're buying it at a diminished value. So is it really, you're buying it based on an actual number, but is it really a 4 cap? What you're hoping to do is you have interest rates of, let's say, 4 or 5%. You're buying something at an actual 4 cap. You're around positive leverage. You may not be there, but we are hoping and you're praying, and through Jake and Gino's activities, and you're listening to this, or you're just an awesome real estate investor, you're able to really grow that NOI. And then all of a sudden, the property that you had bought at an actual 4 cap, all of a sudden is at a 9 cap. You've just increased the value to the NOI to make the property at a 9 cap. Now rates are at 6, you have a 9 cap. What you can do is you can actually compress that property back down to a 4 or a 5 cap, whatever the market is, and either sell it or refinance it. That's the idea. If you're going to take a risk and buy a property with a low cap rate, just understand yield of cost. It's freaking great. We've done it forever. And for us, we don't sell. So we're looking at a property, and let's say that NOI is $100,000, the NOI. We know we can get it to $150,000. Well, we have $50,000 of NOI. We're going to take that chance. But here are some steps to do and to really ponder and to really think about if you're going to take this risky strategy, because all bets are off. Are you able to get the rents up? That's what's really important. I listened to Trump's book. I was reading it the other day, The Art of the Deal. He's got a great step framework. I actually did a video on the how-to. Go back a few weeks back. I was talking about his framework. Now, if you can take care and limit the downside, he says the upside will take care of itself. That's what you're trying to do when you're trying to buy a property with value add. You're trying to buy it at a decent price. The problem is, over the last couple of years, there was so much frenzy, so much activity in the market. People were overbidding these properties because rates are so cheap. So your cost of capital on a lot of these institutions, 2%, 3%. Well, if you're buying a 4 or 5 cap, you have the positive leverage. And then all of a sudden, you're able to, add value, raise rents, and rinse and repeat. But like I said, what happened? The market came to a crashing halt. Rates shot up so quickly that a lot of these operators got caught off balance. Now, the first thing, if you're going to implement the strategy and you're buying with high interest rates in this interest rate environment, you need to be careful right now with rent growth. In our market of Knoxville, the last 6 months, rents have stagnated. It's really weird. And why is that? If you want rents to go down or to stay flat in a market, you don't need rent control. What you need is supply. You need to cut these regulations and you need to build. A lot of people may hate that. So you can't have both sides of the same coin. You can't say to yourself, well, I want to be able to have housing more affordable, but I don't want to be able to build. Look at states like Minnesota, Minneapolis. They've done it there. You can come and look at Knoxville, which is still really affordable. I think average 2 bedrooms are like $1,300 to $1,400. Why? Because all of a sudden we've had a lot of supply come on the market in the last 12 to 24 months. Well, when supply comes on, all of a sudden it keeps up with that demand and renters have more options. So if you're going to be buying right now with these high interest rates and you think you're going to go in and get 8 or 10% rent growth, be careful. I am telling you right now, in a lot of markets across the US, that's not going to happen. Now, there may be certain markets, believe it or not, in New York, where all of a sudden the demand is so great, they don't have as much supply, but just be careful and make sure that you understand that if you're buying a property that has rents for $800 for 2 beds, that you can get those rents to $1,200, not through growth or not through rent growth, but really just through repositioning the asset and bringing it to where it should be. We call that valuation through operation. That's what's going on right now. You're not going into the market and renovating a unit, spending $10,000 or $15,000 a door, putting in granite, new cabinets and all that. That doesn't work in this part of the market cycle. Be careful of that as well. The second part, if you're buying with high interest rates right now and you're looking to exit in 3 to 5 years, be careful of buying in secondary and, more importantly, tertiary markets. What happens right now when things were getting really, really hot and all of a sudden you had people in California, in New York, in these big markets that needed to place capital, well, these primary markets got to be too expensive. 3 caps, 4 caps in Atlanta, and all of a sudden they started pushing out. Macon, Georgia, getting 4 and 5 caps? Really? Is that how crazy it got? Valdosta, all these tertiary markets were getting bid up. Cap rates were dropping. Just be careful right now. We're actually looking at a deal right now in a tertiary market. It's got a smaller population. It's outside the metro. You really have to buy this property at a good basis. Really, really important that you do that. And if you're not managing the property yourself and you're hiring third-party property management, you better make sure that there's some qualified managers in the area. And if you're looking to exit this thing in the next 2 to 3 years, there aren't going to be as many buyers in this type of market. When there's less population, there's less demand for that asset, especially from institutionals. You're going to be looking and trying to sell these properties to mom and pops. Now, there's nothing wrong with it. If you buy this property with your eyes open, saying, I need to really buy this property, buy it on actuals, not give myself this crazy rent growth, operate this property and cash flow this property. Hey, and in 5 or 6 years, rents are up 10, 15%. I've done a good job with managing it. Then you may be able to exit it. Just understand what the exit looks like when you're buying in tertiary markets. Now, this third one may seem obvious. I mean, when Jake and I started, we're always buying on actuals. You look at a property, you're buying at an actual 8 cap, you're buying with in-place income, you're buying at a 7 or 8 cap. Well, when the market cycle lengthened, that, rule went by the wayside. Now, if you're buying with high interest rates, you need to get your debt service coverage ratio at least at a 1.25. Just be careful with bridge debt. Nothing wrong with it. I'm going to share a secret with you right now on how you go broke in real estate. There's 2 ways. You either run out of money, which is pretty obvious if you don't have the repairs. If your property is negatively cash flowing, you can't pay your mortgage, you can't pay your bills, you go out of business. The second one is a little less obvious to those who are newer. You just run out of time. Well, if you're buying a property like people did 2 and 3 years ago, and they're on bridge financing, and you're seeing what happens with the cost of capital. When the cost of capital goes from a 3% to a 7 or 8%, what that does to your mortgage payments and to your business plan and to your expenses, it just blows them out of the water. So if you're not buying on actuals, you're already speculating. And then you're buying it at a low rate, but that low rate is locked in for only a certain period of time. And you run out of time, that's how you lose money in real estate. Just be very careful. You're either going to run out of money or run out of time. Don't put yourself under so much pressure. Well, you may be saying to yourself, yeah, Gino, great. If I don't use bridge debt, then I won't get a deal. No deal is better than a bad deal. Ask me how I know. I've bought a couple bad deals in my life. I had the I'm a mentality. I'm a guy to do something. The fear of missing out. Let it pass. You've got plenty of time. Don't be in a rush. Buy on actuals. Now is the time where you can go to a broker and say, hey, this doesn't make sense right now. I can't get financing for this. And you're not going to be the only one that's saying that to the broker. And ironically enough, if you're listening to the residential market, I'm not sure about the stat, but I read somewhere upwards of 15% of deals that are going under contract are blowing up right now because the appraisals aren't coming in. And there's this weird disconnect between sellers and buyers. Sellers are saying to themselves, well, my property's worth this. I mean, it may be worth that if rates were still at 3.5% or 4%. Yeah, you could pay that theoretically, but rates aren't there. And oh, by the way, trying to project and extrapolate income growth for the next 3 or 4 years, it's not where it was 3 or 4 years ago. So you've got that double whammy. And then the appetite with debt. Debt's a lot harder to secure. You're going to need more money for a down payment, which means your returns are going to be diluted. There's more risk for you to get into the asset. Do you need to pay that price? That's why buyers are saying, I'm not going to overpay. I'm going to buy on actuals. And as the market starts to normalize, starts to slow down as we are right now, that's what's starting to happen. If you're a seller that doesn't have to sell, you're going to hold on. You're going to wait for the market to rebound. But if you have to sell right now, you're going to be taking a haircut. And this fourth one, this one's really important. Before I share the fourth one with you, if you want a copy of Wheelbarrow Profits, just email me, gino@jakeandgino.com. We go over buy right, manage right, finance right. I'm going to hold up my most recent book. It's called Happy Money, Happy Family, Happy Legacy. I wrote this book because of the impact that multifamilies had on my life and has had on the life of the entire Wheelbarrow Profits community. It's been incredible to see an asset class, a vehicle that I learned about, and I've been able to teach hundreds of others how it's affected their lives. If you want a copy of that book, PDF copy, email me, gino@jakeandgino.com. Now, this fourth one, Jake and I are up against this right now. Like I said, we were just looking at an asset built in the 50s or 40s. Some of these buildings are even older. Be careful with older assets right now. You're seeing these older assets that were trading at 3 and 4 caps in certain markets a couple of years ago because you could get away with it. Remember, interest rates were lower, cost of capital lower. Once again, you still had positive leverage. You can't buy a 1960s asset at a 4 cap right now when rates are 6 or 7, unless you can perform some Houdini, some magic, where you're going to really crank that property up and get that property. First of all, banks and debt don't like the risk that's inherent in these older assets. Cast iron plumbing, aluminum wiring. You have a lot of old decks, old roofs, old HVAC units. There's a lot of money that needs to go into these assets. Be very careful. If you're going to buy an older asset, not saying don't do it, but you need to buy it for a really good price. And number one, the other part, remember when I had said the one I just mentioned, you need to buy it on actuals. You need to buy these assets at an actual 7 cap or 8 cap, whatever they're trading for in your market. I know in certain markets, prices haven't come up as others, but I would be very careful with older assets. We're looking at a couple right now. Problem is that we want to have central air in units. This buildings don't have central air. We'd like to have brick. These have brick, but they're flat roofs. The brick looks terrible. Electric wires outside are exposed. There's, like I said, no central air. And that does is you have a different quality of tenant. Driveways are a disaster. There's so much CapEx involved in this property that you need to buy it for a really, really good basis. You need to understand it's going to take you at least 12 to 24 months because a lot of these tenants that you're inheriting, they're not going to be there. They're paying $500 and $600 for a 2-bedroom. Well, once that property's done and it's refinished, refurbished, repositioned, they're going to be at 900 and 1,000. So you have to weather that storm as well. So the great part about it is you can buy this thing on actuals where, let's say, theoretically, a couple of years ago, that asset would have traded for 80,000 or 90,000 a unit. Right now, that asset's trading for 50,000 to 60,000 a unit because the appetite isn't there. That's the first kinds of assets that get on the shelf, and those are the ones that are really having issues because they're the ones who started the work, but all of a sudden they didn't get repositioned, and now they're stuck. And now rents didn't go where they were supposed to. And insurance just got jacked up because they came out and inspected the property. They're like, this property is a nightmare. We're not going to insure you for what we were insuring you. We're going to jack up your insurance rates. Rents aren't going up as much as they should have. Your expenses are just going through the roof. You've got so many repairs, you can't handle it. So just be careful. Be patient. We're still buying and looking at older assets, but we're going to make sure we're going to buy them at the right price. Now, I want to run through these 4 real quick again. And don't make interest rates being high an excuse for not looking deals, for not walking deals, for not talking to brokers. It's okay. Just make sure you give the broker your opinion on the asset. This old asset that we're looking at, we're literally going to call the broker, and the broker knows. We're going to say, hey, we like the asset. We like the area, actually. We like the median income. It's just such a heavy lift. It's just too much work for us to get there. There's not enough what we would call meat on the bone, although we can get rents to $900. If we're into it for 70,000 a unit, not bad. But once again, it's in a tertiary market. So don't let interest rates, dissuade you or give you the impetus to continue to look. Because if you're looking right now, and you find a deal that works at these rates and you're able to reposition it, and in the next 2 to 3 years rates drop, well, you may be in for a refinance bonanza. So number 1, be careful with rent growth. Number 2, be careful with tertiary markets. Number 3, buy on actuals. And number 4, be careful with older assets. Think about the yield of cost and always think about positive leverage. As always, thank you for spending part of your day with us, and I will see you on next week's How To. Take care, everyone. Thanks for tuning in. If you enjoyed today's video, be sure to like and subscribe so you'll never miss another episode.